It's time to talk wealth management, brought to you by T. Rowe Price. The high net worth investing space will grow to $70 trillion by 2021, this according to EY. So how will the wealthy put their money to work? Joining us now is Alfred Eskandar, co-founder and president of SALT Financial. Great to see you again. You guys develop data and indices to help investors customize their portfolios. So we all went through the washout in Q4. Here we are. We've just been talking about the sort of V-shaped recovery that we've had a little choppy day today. But what are the trends that you're seeing in high wealth? Did all these people get to participate on this recent rally?
I think it's all about risk management when you talk about the ultra high net worth. So if you think about it, there's two kind of clubs, those that are trying to get rich and those that are trying to stay rich. So those that are trying to stay rich have unbelievable service. They get tremendous value from advisors who have these new technologies and tools. And what's really driving a lot of it is risk management. And that's the hottest topic these days.
And when you look at the financial industry in general, it's really surprised me the way the last I guess a post-crisis trade is, if you want to think of your business as a trade, is like catering to high net worth clients, right? Because it's a more reliable revenue generator. Of course, you're not really able to trade the prop desks the way a lot of these firms were in the past. I mean, what do you make of just the trend towards trying to attract wealthier and wealthier clients from the standpoint of how it changes the financial services industry? It's not really you go out and trade anymore. It's you just kind of go make calls and try and get people to give you their money.
Well, it's also a reflection of just the fee-based approach, right? You're seeing a number of advisors take the more independent route. And that is driven by their ability to access products, their ability to have more freedom, and their ability to interact much more on an intimate level with their clients, thinking about estate planning, their kids' schooling, et cetera. So from that approach, you are seeing a lot of money sit still, which is exactly what advisors want because it's sticky assets. They stay over. They're not trading oriented where it's really more of a transaction.
Alfred, when you talked about that risk management, what does that mean, practically speaking?
Well, I don't think there's enough topics given to just how much risk is in a portfolio. I mean, we're fanatical about it. That's all we do. That's all we think about. And in days like this, when your portfolio has let's say a sensitivity or a beta of 1.2 and the market's off 1%, well, you should expect to have your portfolio off 20% more than the one, so 1.2%. And when advisors have that conversation with their clients, they're not getting that panic phone call when the market's down a couple of percent and they're panicking. They already had that discussion. They're aware of the risk levels. And more importantly, they could dial it up or dial it down. So depending on...
So really explaining beta and where that's positioned and how you're exposing yourself to more risk or less risk and be aware.
There's not an investor that wants to take on unrewarded risk. Right. So if I have more risk than I want, the market goes up, hey, we're doing great, I'm very happy. But if I'm surprised to the downside, it's a very difficult conversation for the advisor.
What about the active versus passive issues for high net worth? I mean, you hear like Warren Buffett will be like, just go into an index fund.
Sure.
But come on, like rich people, they're not in just index funds, are they?
You'd be surprised. Absolutely.
That's how they got rich.
Well, there's also all sorts of other products, right? You do have custom structured products, for the ultra high net worth group. But more and more, ETFs do offer so much that what the active used to offer. So the veil of factor investing, the veil of a particular tilt has now been available in an ETF wrapper, which makes it highly accessible. And it's also, very affordable.
And when you look at just, taking a step back from high net worth clients, just the market in general over the last, 10, 11 weeks, have you been surprised at the strength of this rally? Have you been surprised by the rally's existence at all? I mean, it has been kind of a bizarre period for markets where a lot of the decline seemed inexplicable, and so did the snapback rally in a way.
Well, 2018 was very particular. If you look at the growth of the market in early part of the year, it was really driven by technology. Technology also took us down towards the end of the year. we had a massive spike in volatility in Q4, which has been really drifting down up until today. So if you looked at the VIX yesterday, it was around 13, and I think that's where it kind of bottomed out. We're up to over 16 today. It's a 20% move in a single day. So what we're seeing is, unlike 2018, 2019 rally has been broad-based. We've had a lot of sectors really participate and take us higher. In fact, I believe all the major indices are up in double digits still. So that's healthy. That's a definitely good thing for the market overall, is when you have a much broader participation.
And what happens the rest of the year from where you sit?
Well, we've been incredibly happy so far with the performance of our fund, SLT. We're actually going to rebalance next week on Friday, and we hope to pick up additional, high beta names for the second quarter and continue. The two things that were really holding us back are positive today, which is the news with China, and the Fed has kind of hit the pause button. So,
wait, you buy higher beta things in a flat market?
Yeah.
So we have it up right there. Yep. That's your high beta.
Okay, so
yeah, and that's a wonderful.
I'm just trying to wrap my brain around that. So when the market's not really okay, sure.
Well, it's also correlated. Yeah. So when the market goes up, this should go up more. But when the market goes down, it will also go down more. So it's a magnified returns to what the S&P did.
Huh. Okay.
Yeah.
Alfred Eskandar, Salt Financial. Thanks so much for coming back. Great to see you.
Pleasure.